Hello and welcome to Investing Confidential. Yesterday spoke a lot about the macro situation. Not good. It's just deteriorating. Okay, and I want to get back into that. But today I'm going to talk about the stock market. The market ramifications. It's not all going to be negative. Okay, I do have some recommendations where you should be allocating money. I'll talk about it a little bit. But first, I just want to go over one thing on the macro side. This is just one slide. It's really something you have to pay attention to. Okay, so here we have the U.S. the 10-year yield, okay, which has spiked up from almost zero to over almost 5%, versus the size of the auctions. Okay, and these you could see most of this in 2020. This was COVID. And we spent 6 trillion. We printed most of the money on the printing press. We borrowed a ton of money here monthly. I mean, literally billions, hundreds of billions on a monthly basis. And here's the issue. A lot of the auctions were not just 10-year, they were 2-year, 1-year, 3-year, 5-year. And the problem is that as these shorter maturities come due now, we're seeing it right now over the next 2 years, unless the government and Wall Street can manipulate the rates lower, the interest on our debt, the payments on it's now $1 trillion, as we show. It's going to skyrocket. It could reach 2 trillion. That's a nightmare. It's going to go way over our defense spending. I mean, this is a real disaster scenario for the dollar. Okay, again, I'm talking about the dollar assets. And the dollar is the key to inflation. If the dollar weakens too much, commodity prices are going to, the inputs, commodity prices, they're going to go, and inflation will remain very sticky. It may actually start going up. So you gotta pay attention to this, folks. This is really important. Okay, 10-year yield, the auctions, all of that money that we borrowed, not just 10-year, but we borrowed a lot, is all coming, has to be refinanced because we can't pay for it. Significantly higher yields. Okay, it's a mess. All right, so we saw that. Now let's just. I want to show one thing that's really interesting here. I saw this recently. This is asset bubbles. Okay, you look at this is really interesting. You look at the history of asset bubbles going back into the 70s, and it puts everything in perspective. I got to tell you, you look back in the late 80s, Japan, that bubble was enormous, absolutely enormous. I mean, like I said, valuation stocks in Japan were trading average stock was trading almost 100 times earnings. Okay, 1-bedroom apartments were going for $5 million, $6 million, $10 million. So Japan was and look at it in perspective. Then we had the Asia crisis, that bubble. Then we had the internet crash, and you see where these go. They all go negative. Okay. Then we had our housing bubble. Okay. Then we saw the big, China stimulus get themselves out of the problems that we had, but now it's all crashed and it's going lower. Okay, and then the big one here is Bitcoin. I'm not going to make any comments on Bitcoin. You look at this and you tell me what you think. Okay, you got to be just careful here. And then you got FANG. Okay, again, the 7 stocks, the Magnificent 7, they are bubbling, and they've had a double top here. Okay, and all these bubbles have one thing in common: they all go negative. Okay. They all go negative. China took a little longer, but now it's negative. So watch out for Bitcoin and watch out for FANG. These are bubbles. Okay, that's all I'm going to mention about that. And now, very important here. I think it's important to see what has happened in the last quarter with guidance. Okay, guidance is obviously what every quarter the companies come out with forward guidance. They give you an idea, what's going on in the future. They give you a little preview. And as you can see here, okay, guidance is being revised here in the first quarter of 2021. with the COVID. That was, but look at today. I mean, again, put this in perspective. We just had supposedly GDP at 4.9%. Supposedly, I don't believe it. But look who we are in guidance. We're back to 2015, 16. We're going down to 2013. I mean, this is 10 years that we're starting to, and that is guidance is forward looking for earnings and revenues and top line. This is not good. It's not good. Okay. Now let's look at another interesting. These are all esoteric stuff that you don't see from Wall Street. This is the Federal Reserve balances. Okay. Again, the Federal Reserve balance sheet, in 2021 was at all-time highs versus the S&P. So the Fed's been reducing their balance sheet, which they shouldn't be doing. They should be doing a lot more, but they're reducing. But look at the S&P. This is going to mean revert. Okay, is the Fed going to increase their balance sheet dramatically? No chance, zero chance. Especially with these rates at these levels, no way they're going to be buying bonds. So guess what's got to mean revert? It's got to do the S&P. And if the S&P to a mean revert down here, you're talking 25 to 30% downside. That's a reality. That's a reality. Now, is it coming tomorrow? No. But the S&P and they're so linked. Okay, this is stimulus. They're so linked that the S&P is going to mean revert. It has to. And that would put it right around testing pre-COVID lows or the COVID lows or pre-COVID, which is what I've been calling for. But anyway, that's just something, again, you got to look at these things in a longer term perspective to understand. Now let's look at global concentration. Again, another thing you're not going to see from any of the talking heads. Okay, now what I want to put this. So here in the U.S. we have the Magnificent Seven stocks leading. It's the most concentrated. The breadth is the most thinnest it's ever been, but it's happening all over the world. Look at this. The largest tens, and most of them are U.S. by the way. It's Apple, etc. But this is red. This is massive red flag. This is the highest in the history of the MSCI All World, what they call the ACWI index, the highest it's ever been. And the interesting part is that the stock markets in Europe are trashed. So guess again, this is the U.S. The U.S. is the cause of this. The U.S. equity market is the key to everything, folks. It's the key to real estate, key to everything. Consumer confidence. When this thing goes, all of the stuff that people have been scratching their heads it's all gonna come out in the wash. Okay, and who owns stocks? Okay, let's hear. So as you can see, it's you. It's you. Okay, starting like in the it's you right now, meaning house ownership is the highest it's been going back to right before the internet bubble. But I want to focus on at the bottom here, foreign investors. They have the largest exposure they've ever had, 17%. And as we talked about with the US dollar, I think these guys are going to fly out of this market. And no one's going to be able to accept all this. The market's illiquid, first of all. When they start liquidating, which they will, it's going to be a problem. Again, these are big factors. But also, it all comes down to, obviously, valuation. And valuation is the key to everything. It's for you, if you're a trader, you got to pay attention to valuation. Okay, and first here, we're going to look at the U.S. market, you see here, versus the earnings yield versus the volatility. Global. Put the U.S. in perspective. So obviously, if your market is cheap, you want to have a high earnings yield. Earnings yield is the inverse of the PE. And versus the volatility, implied volatility. That's the movement of the markets. How volatile is the market? We see China, the outlier, looking cheap, high vol, which is a negative, but very, very cheap on an earnings yield basis. You don't want to be out. You don't want to buy stocks at their 27, 30 vol. You just don't want to do it. Even EM, which I'm going to talk about a little bit, is just way out of the mark there. But look what's interesting. The UK. I'm going to talk about the UK. I'm going to do one video on the UK. UK is very interesting. Again, UK is not Europe. They left the EU. Very interesting. But let's go back to the US. Look at the US. It is the most expensive market, the lowest earnings yield, except for India. Okay, and look at the vol. Very obviously very low vol, which is good, but it's too expensive. Very, very expensive. Again, with the exception of India. It's the most expensive market to look at. And now here's the US on just plain and simple PE. And this is I like these charts because you look at the US versus the median, or all the countries versus the median, and then a range. Okay, and again, historic ranges. So look, the blue is where you are today. The red is the median, and then the shaded area is the range. You want to be ideally right around the low end. The blue mark wants to be at the low end, underneath the median, right at the lower end of the range. Then you know it's pretty interesting. So look at the US, folks. It's the only market valuation-wise which is trading way above its range, way above its median, and way above everything. This is facts. This is not some crap government data that comes out, fake government data, manipulated. No, this is plain fact. Again, I talked about the United Kingdom. Look at the UK, trading significantly below its range. Same with Europe, but Europe's got a lot of problems, and it should be down there. But these are cheap markets, very cheap markets. Okay, very cheap markets. The emerging markets, that includes China. Again, it's cheap, but not yet. You need the dollar to help you. The dollar hasn't started. When the dollar starts going down, that's what you got to buy. These things, the emerging markets will skyrocket. But for now, the outliers are on the expensive side. The U.S. massively expensive, and the U.K. looking very interesting. Okay, so bottom line is U.S. equities, not the place to be. It's not the place to be. So where do you put your money? You know, as I said yesterday, again, I'm looking a lot longer term than you guys do. Commodities, emerging market stocks and bonds. This is where you're going to see significant outperformance versus the U.S. over time. But you need that dollar. Okay, you just got to watch the dollar. The dollar hasn't yet cracked, and when it does, boom, you got to pile into these. Okay, but I think we're at a turning point. As I said before, I think we're at a turning point. So one emerging market that I would look at today is here. Okay, as you can see here, Mexico. And I'm putting this chart up not for the valuation, but just what is happening in Mexico. There is an explosion of investment going on. This is the ideal situation on a macro basis. You have, companies, governments, everyone's investing in Mexico, putting up plants, jobs, all of this. And it's because of one thing. It's called nearshoring. And nearshoring is a term, if you haven't heard it already, basically what it is, it's bringing back our manufacturing, bringing back the business cycle to the U.S. And obviously Mexico having the trade agreements, being close to the U.S. It's a perfect place to come if you're Chinese, Taiwan, European, no matter what it is, to set up operations. And this is why Mexico, the currency's been strong, the market's been fairly strong, but it's really just a few stocks. And the reason I mention it is I think there's still a big opportunity in Mexico because the overall market hasn't moved. Okay, a lot of investment going in, but the market is not expensive and it hasn't moved that much. So Mexico is a place that I think versus the US where you have an entry point today. Okay, And then something I've mentioned before, small caps, as you can see here. I mean, the outperformance of the large caps versus the small caps it's just extreme. But you're at, an incredible buying opportunity, both valuation and here in terms of performance. Massive outperformance by, let's say, the large caps versus the small caps. And could it go lower? A little bit, but this is extreme. Very, very extreme. So I think you got to look at, small cap stocks. Again, the Russell 2000, you could buy an ETF. You don't want to buy individual names. That's fine. So the IWM, short the SPYs, S&P, that's a trade you can hold for a long time. It's volatile as hell, but that's an interesting trade. But small caps is definitely somewhere where you need to have some type of exposure. And then in other areas, I think this is really interesting. Look at bank stocks versus the S&P. This is really interesting. Bank stocks are at their lowest level. Actually, they're at an all-time low level. It goes back to the 30s and 40s. I mean, this is extreme. This is extreme underperformance by U.S. bank stocks. I just saw this. This is something recent. I saw this and I was like, this is very, very interesting. Very, very interesting. So certainly U.S. bank stocks could be very interesting. And banks usually do very well when rates are going higher. They do. They just, higher inflation, they do very, very well. And then I'll just mention gold. Okay, as you can see here, you got to, what's going to move gold? Well, you've seen central bank buying. Okay, the dark blue, that's just the first 3 quarters. They usually continue buying into the fourth quarter. We're going to see continued buying. It's not letting up. And it's obvious. I showed yesterday, they're getting out of the treasuries, the US dollar, and they're buying gold. And they got a long way to go. Long way to go. So gold is something to take a look at. And well, so going back to the US, it is a lot of negative things going on, but certainly you got to be careful. And this is reason, and right now you can see the reason why we've had this rally this week. The market was extreme levels, and now be very careful now because we're at extreme bullishness. IWM call option volumes. You can see it in the put call ratio, wherever you want to look at it. Everyone's bullish. Everyone thinks the Fed stopped, may cut. I told you last video, I haven't seen it, go back to yesterday's video or the last video I did. Fed's not cutting. The Fed may be on hold for a long time, but they're not cutting anytime soon. And all this bullishness, people are way too bullish, as you can see from the calls on the IWM. So that's the situation with stocks. US, stay away from it. I'm not saying sell today, but you need to really have other options available because I think the US is going to be a major underperformer going forward. So if you're an investor, be careful out there.